Welcome back to the Economic Analyst channel. In this video, I'm going to go over the Producer Price Index report for June 2022 that came out this past week, and the numbers were quite startling. So while I have been observing that the commodity prices were already starting to drop from June, as evidenced by this DB Commodity Index Tracking Fund, where commodity prices have dropped by some 15 to almost 20%. In the month of June, from the Bureau of Labor Statistics report, commodity prices increased by a whopping 3.3%. This is the highest monthly increase that we've seen in the Producer Price Index in quite a while. And really, we would have to go back to the 1970s to see monthly changes that have reached the heights that they have right now. We'd go all the way back to 1973. On an annual basis, the Producer Price Index has hit another peak because of this for commodities. It's increased up to 23.4%, surpassing its previous peak of 22.7 in November of 2021. And again, we have to go back to the mid-1970s to see producer prices this high. Now, what gets commonly reported is not the commodity prices, which is the earliest stages of production, but rather the final demand prices, which is the last stages of production before reaching the retail stores and hitting the Consumer Price Index. And final demand numbers also increased by a strong 1.1% change from the previous month, and that pushed final demand numbers back up to 11.2%. The major driver of this was clearly energy. Energy prices on the final demand front increased by a whopping 10% in just 1 month. Transportation and warehousing also contributed to this. But other things to take note is that if we subtract out food and energy, then your Producer Price Index would have been a 0.5%. That's your core producer price inflation. And that's much milder than what we have been seeing for the past 5 months in 2022 and nearly every single month in the second half of 2021, save for a low number in December. So it seems to suggest that outside of this really bad energy spike, that we're beginning to see a cooling down in core producer price inflation, which should, combined with lower commodity prices, feed into lower commodity numbers in the coming months. And that will bring down this producer price inflation, which is half of the major component that goes into the CPI, the other half being wages. So when we take a look at gas prices from EIA.gov, this seems to corroborate the idea that we're going to see a very tame Consumer Price Index report and probably a Producer Price Index report, as fuel expenses are dropping, and they're dropping very quickly. So again, part of this is due to commodity prices dropping, a correction in oil prices from their peaks in the early parts of spring after the invasion of Ukraine from Russia. But there may be some political motives that have gone on to this, with the releasing of the strategic oil reserves, temporarily depressing prices back down, for some time. How long this will manifest, I don't know. But when I plug in the numbers into the fuel prices and feed into final demand, this has dropped my final demand forecast for the CPI in the month of July, down to a flat 0.0%. And even though we might see a positive CPI number, this would represent a huge drop in the CPI from where it is right now. Right now, annual CPI numbers are sitting at 9%. If we do get this 0.0%, that'll drop it back under 9, back down to 8.5. Even if it ends up a little higher, that's going to bring down those annual year-over-year numbers, which will be seen as a positive boon, at least temporarily, inside of the talking heads for the economy and the stock market. Having said all of that, looking at the Producer Price Index report right now, we're going to need to see a huge correction in producer prices for commodities to start seeing the annual change in producer price inflation start dropping. If we don't see those huge drops in producer prices, we're going to see a rising producer price annual change number, and that rising number will feed into a more persistent higher consumer price index, which I still have. I still have the consumer price inflation staying at 8 to 9% for the remainder of this year. I really don't foresee it calming down below this. And the two metrics that I use to confirm this, one is my own price formulation index, which is basically a modified version of the quantity theory of money. This seems to be tracking out that there's still a lag between money and prices. The money side is the PFI, or this blue line on the price formulation index, and the orange line is the CPI. And although we're seeing a tightening between the two, we should see a further tightening and a reconvergence of the two lines, much like what we saw back in 2017. And by doing so, that would indicate that we're going to have systemically high inflation, even if money and debt growth stagnates for some time. And this model has been accurate going all the way back to the 1970s. So let me adjust right quick and show you on the model just how accurate it is. And voila. That shows you how much there is such a strong correlation between the price formulation index and the consumer price index. Looking at the business expense index, feeding that into this line, which is this green line here, and I'll remove this blue line I'll remove the price formulation index for simplicity's sake. You can see how the business expense index, which is just an average of producer prices for all commodities and the median wage earned, correlates very strongly with the CPI. This is the trend over the last 20 years. And this trend goes all the way back to the 1970s when I was able to corroborate and aggregate the data here. So using that, the business expense index, those high producer prices still relatively are still going to show that the consumer price inflation is going to be systemic. It's still going to push up, but we're probably going to see peak inflation come this fall, as long as we continue to see a falling in energy prices and a continuing correction in commodity prices. Now, if we don't get this correction in commodity prices and we start seeing commodity prices head back up, as evidenced by index tracking funds pushing back up, then that will escalate and further exacerbate the tensions of the producer price inflation and make consumer price inflation more entrenched, more ingrained, and could cause it to rebound and actually reignite its push upward toward 10%, which was something that I held a few months ago. So this real drop in correction in commodity prices has been very surprising, especially considering the timing of it with energy prices over the hot summer. It is very easy that geopolitical and other types of forces can start pushing these commodity funds up. But my guess is that the major driver of what's going on right now has been the lagging economic indicators. So the fact that the economy is beginning to stagnate and the GDP Nowcast numbers, which is produced by the Atlanta Fed, is showing a contraction in Q2, confirming a technical recession on the economic front. This seems to indicate that businesses are delaying capital expenditures, purchasing of goods, and this drop in demand is what's causing these relative drop in commodity prices, as we've seen commodity prices on this index fund reach levels that we haven't seen since the beginning of the war between Russia and Ukraine. Now, it's anybody's guess whether we're going to see the bounce back or not. My guess is that we'll probably see a new consolidation here and probably a little reemergence upward. It just depends on what's going to happen with the demand for those goods and the consumption of those goods. One of the major factors that has been driving the stagnation in producer prices has been this stagnation in the money supply. So money supply and debt growth are the major factors that go into bidding up prices. If you're not getting new money, then you have nothing to actually bid up prices with in terms of nominal demand. After all, higher prices is just a reflection of how much money is in the system demanding for the same quantity of goods. If prices are going up and quantity staying the same, the money supply is going up. The fact that we're seeing the money supply stagnate and have stagnated for most of the year indicates that the bid for commodities, it would indeed encourage a correction, and probably will stay around this level unless if we see M2 numbers start to increase. So one of the reasons why M2 numbers are starting to stagnate so much relative to their highs is the fact that government spending relative to its peaks in 2020 and 2021 with COVID bailout stimuluses are largely self-correcting downward. So we're seeing this cut in government spending relative to these peaks in money being pumped out into the economy, and it's been dropping by some $2.7 trillion on the federal and state levels. Most of this is federal spending, and we're almost back down to a normalized section of nominal growth. In other words, we're almost back down to normal annual government spending numbers, and we'll probably reach that with the gridlock that's been going on inside Washington. And what that has done is that it has had an effect on the General Treasury account. So the General Treasury account is basically the government's bank account that it uses to spend, yet the General Treasury account has been building up in funds by hundreds of billions of dollars from the end of 2021. Why? Because it's collecting more money, it's collecting more in taxes, it had levied out a last round of bonds, and now it is not spending money so quickly, so the drawdown in this General Treasury account is occurring much more slowly. Well, that General Treasury account pulls from bank reserves, and bank reserves are funds stocked away at the Fed. It's not the active money supply, and the General Treasury account is also at the Federal Reserve. Therefore, it doesn't count as part of the money supply. So if the government is spending less and it draws from bank reserves when it levies debt, that in turn is causing a decrease in demand for new dollars that the government wants, that it cannot get from tax revenue, and it cannot and it doesn't borrow from banks, which is borrowed from bank reserves. That is money not yet into circulation, which is causing that stagnation, at least in part, of the money supply. The other part could be that there's less of a demand for debt. For debt overall, that is possible in the wake of a lagging economy. So all of this is factoring into what I would say would be a stagnating or / dropping commodity prices in the producer price index, and in so doing, that will cause a stagnation in the consumer price index. So just to recap, and then I'll wrap up. Looks like that the relative drop in energy prices is going to keep this downward pressure on the CPI at least for 1 month. We'll see what happens in the coming months, whether that can continue. And if the producer prices start falling, that will also relieve pressure off the CPI as well. As always, guys, I thank you for watching this video. If you like the content that I provide, make sure that you show me some support. You can always like the video, subscribe to the channel, click the notification bell so you're notified anytime I do update, which I try to update at least once a week with new data and information that comes out about the market. And stay tuned. Probably the next video is, and I'm going to give an update on some of my other charts on the economy, including my debt default model, where we stand on that and what I expect in things to come in light of the new economic information that's been coming out. Once again, guys, I thank you for watching this video, and I'll talk to you next time.